opportunity, without any additional notes of welcome, is to welcome you as our keynote speaker, first keynote speaker of this conference. Professor Waltraud Schelkle, you are professor at the European University Institute since 2022. You have been before at LSE. And on the train here, I noticed that your habilitation was published in Heidelberg. And from that, I inferred she must have been a colleague from me in Heidelberg in economics, which unfortunately turned out to be wrong. So she has a training in economics, but not from Heidelberg. She was in Berlin before, a master in economics, a PhD in economics, and then this development in the direction of political economy, for which she is widely known, most above for her research on the political economy of monetary integration. And I assume many of you will know her 2017 book, which is widely cited, on the euro experiment. Today, she will be talking on the emerging system of reinsurance in the EU, and I'm looking forward to learning about what that is. I wouldn't even know what to expect in any detail. Well, welcome to Zurich. Waltraud, the screen is yours. I thought when I read this remark here that this session is online, but luckily you are here, and it is online in addition, which I'm very happy to hear. And yeah, we have 45 minutes for the presentation. We have an additional 15 minutes for the discussion. Welcome. Thank you.
Thank you very much. Thank you very much for having me, for having invited me to this. I was so immersed in admiring your campus, also the University of Zurich, with my friend Stefanie Waltraud, that I was almost a bit late, but I was glad that you have a, not exactly a Swiss clock kind of approach to starting here. I'm glad to hear that somebody isn't quite sure what this is about, a reinsurance, the emergence of a system of reinsurance in the EU. By the way, if you have difficulties to hear me, because my voice is not a very good one for big rooms, and I prefer to talk to this microphone than having a headset, but if it's difficult to hear me, then I'll put this on. So let's start with something from how we know reinsurance. So reinsurance is insurance of insurers, of primary insurers. But just imagine for a moment you work for a government in a small country, far off place that is known to be very prone to earthquakes. In fact, so what would you do about that fact? That you can expect that you're hit from time to time. It so happens that Christchurch was actually not a hotspot for earthquakes. It had one in September 2010, and then an aftershock in February 2011, and that aftershock was catastrophic. Catastrophic. It's one of the biggest reinsurance cases with way over $20 billion ever. Only some other in the US and one in Australia were as big as that. I will not go into the exact reasons why that is, but rather first noting this thing, I will come back. The weaker earthquake, because it was a weaker, it had not the same strength as the first one, was the catastrophic one. And you needed for that contracts that actually allow this, because you can have contracts that only take the first hit. Since aftershocks are such a conventional thing that sometimes reinsurers exclude that, do not compensate insurance companies, private insurance companies that have taken that out for that. But in this case, there were a lot of contracts where these policies that insure if you have at least twice hit by something. The government in New Zealand provides actually for almost every home, the residential properties, the unit, an insurance contract that covers 100,000 NZ dollars of building damage and 20,000 for content. This is too low for many households, so they take out a second insurance and want, in a way, full rebuilding of their of their building when it's hit. That created a difficulty that also governments very often say, when you rebuild, it has to be to a higher standard. We know today how to make buildings more proof for when an earthquake comes. Again, increasing costs. And I want to stress this as well, that you sometimes rebuild, but not just in the same way, but to a higher standard. Okay. So, and the insurance industry actually supports this thing, even though it immediately raises their costs. So what would you do as a government official in such a country? What happens is whenever there's an earthquake, it's not only the private insurance companies, there are few highly concentrated businesses there. In the case of the Christchurch earthquake, one went almost bust and was bailed out by the government. But the government itself, being a major insurance provider, was also hit very hard by this, right? So it's a classical correlation problem where we say there is no, you can't share the risk among those who are not hit by it and those who are hit by a shock. Diversification, benefiting from diversity. You were all hit at the same time. And against that risk, private insurers take out normally reinsurance. This is why most of these firms had taken out insurance. One knows it from another. Sometimes half of all the payouts they have to make is actually insured by other insurers. Swiss Re is one, Munich Re are the big insurers, reinsurers of the world. And so this is the solution. This is what you would have to think about. How can you reinsure a country that is otherwise on its own, is not part of a bigger structure in which one could think about such reinsurance scheme qua membership in this organization? And this is, of course, the link to my topic today. Did I show you this earlier? No. So I never went back to this. What am I not doing? Sorry. So this was what I meant to show you. Sorry. Let me give you the argument in brief. It also doesn't move now on here. I need then to look at the, can somebody set this up such that I see my own slides? Otherwise I keep on talking to the screen, which is not exactly ideal. It was earlier on in a, yeah, it's okay, good, thank you. So what reinsurance does, it only takes the tail risk of any loss you've made. When insurance was developed, you know, sea expeditions, trading, it was usually co-insurance. Those who sat in the famous cafes in the city of London agreed that if one of them does not come back or loses in a storm most of the load, they would all share in the loss. That's co-insurance. And if you think about it, fiscal federalism is like a co-insurance system most of the time. You have state systems and there's maybe a top-up of the federal system. Only when you had the mathematics that you can actually offer distribution, calculate the tail risks, and it's of course the downside tail risk, could you start to think of reinsurance and provide that in a larger and in an anonymized context. Otherwise, you had to be people who drink coffee or beer with each other, who trust each other that the others will honor the contract and share in your risk. You can, if this tail risk is only 5% of your distribution, you can charge a lower, possibly a lower premium, and you can provide it for anybody. And Lloyd's of London started to provide all this. In our context, important is I transpose this as a political economist from the private context to the public context. So in other words, say reinsurance of member states in the case of catastrophic losses or excess loss, more than we want them to have to carry themselves, is a functional alternative and not just a weak substitute, as those say who consider the EU forever being incomplete or failing forward. It's a functional, full alternative to co-insurance in a fiscal federation. My second argument then is this has come about. We can now see that we actually have something like a system of reinsurance in the EU. And this is where they have converged onto, not because there was a grand design from our joint research center, as much as I'm sure you could design one like that and it would be very sensible. This is where very different interests can find themselves there, this being the acceptable kind of fiscal system that we are building here. And so it's not by design, but by political compromise. This is what should interest us as political economists. Let me first briefly go a bit into the economic mechanism. I note that most of you are actually pretty much economists. I'm not anymore. But I'm always happy to, because I find economics still an extremely interesting field, if only it would stop to just talk in one language that most people cannot understand, would talk a bit more to, you know, what all of us can engage with. The diabolic loop, which was this kind of iconography of the euro area crisis, right? That practically every country, even though it may have started at a different point in that cycle, Greece clearly started with a weak government balance sheet that the recession after the 2008 financial crisis had weakened even further. But 3 out of the 5, Ireland, Spain, Cyprus, started actually where the financial panic is, where, as you all know, in wholesale markets, the financial system froze because suddenly they realized they hold all the same kind of portfolio, and these asset-backed securities had a lot of assets that had many more risks than they had realized when the housing bubble in the United States burst. And so then this balance sheet weakens, that leads to a recession that is made a much worse recession if it needs stock adjustment. In other words, when there's then a credit crunch because the banks try to sell assets that they expect to fall in prices, and that leads, and the households are suddenly have mortgages that are not backed anymore by the value of the house they can sell against it, and so on. This is a much longer recession as we knew then. Economists started to talk about balance sheet recessions that are much longer than a normal business cycle recession. Governments came in big way with national measures to rescue banks and support the economy. There was fiscal stimulus packages, there were all these guarantees, bailouts, bad banks, and so on. Although all these bank rescue measures in Europe in particular, because the banking system is so huge, were not nearly enough to clear all the problems that the banking system had. But it was enough to weaken the public balance sheets, and that led then to market panic when Greece was shut out of bond markets 2009, 2010 that started. Then soon we had Ireland, a country that had never any fiscal problems. In fact, its fiscal situation was perhaps too good to be true because it taxed heavily its housing boom. So did Spain. 2 countries that should, if it's all just about fiscal, as the German story was for a long time, then these 2 countries should never have had a problem. But then suddenly, suddenly everybody saw, their balance sheet is also weak because they have so much contingent liabilities from the banking crisis. And those banks that hold a lot of government bonds then get another problem. Even solid banks that were not engaged in the housing market suddenly all are in trouble because of this diabolic loop. Various circuit breakers were then created. So, of course, we all know the ECB, as early as summer 2007, a year before the Fed did anything, because it was the Greenspan thing was, we write this out another time. They had these crises before 2001 and so on. There was tension in August or July 2007 in the German part of the euro bond market, and they had to immediately check up the emergency liquidity. Then came, of course, that was the Greek story, bailout programs with the European stability mechanisms, the Troika programs with the Commission and the IMF in the driving seat, and an advisory role of the European Central Bank. The ECB was asked early on to engage in asset purchasing programs. So the security markets program for Greece was the first. Always tightly, we do this time 400 billion or something, which we know from Charles Kindleberger. Any pre-committed amount tips the hand of the authorities in favor of the speculators. They can exactly see when this is running out and they preempt this, and so you preempt the next panic. That's why the OMT, of which I'm still puzzled, the open monetary transactions program, you know, the famous whatever it takes speech by Draghi, had such an impact because he basically said, we take out the stoppers if we need. There is no pre-committed amount, and it will be enough, he said. Why this could work is still a bit of a puzzle, and we can talk another time or in the Q&A about it, but it did immediately lower the spreads, and it tells you something about a simple policy design, how much difference that can make, to have it as, yeah, we have deep pockets and we will throw everything at it, or whether you say because of disagreements in the council, whether that's monetization of government, that no, each time it should be a small program that's just for this little country. And he said, forget that, cut it. We will rescue the euro area with our deep pockets. So the OMT restriction was a very important circuit breaker. And then finally, the banking union that again tried to cut this link between weakening banking systems and they're trying to rescue themselves with a lot of negative externalities, side effects on the rest of the economy that was credit starved. Italian middle to small enterprises basically had to live off their cash flows, and the cash flows were not buoyant in a recession, right? Very little help. You may miss one thing, and that's there at the bottom. There was nothing to be done about the recession. So the link between credit-starved economies and ever more demand on governments to help the economy, which they did. When you look at actually the cost of the euro area and financial crisis, I mean, to me, the euro area crisis is the sovereign debt phase of a financial crisis. You see that it wasn't the bank bailout programs. In fact, some countries like the Danish, not in the euro area, but they made actually a profit out of it because there were heavy fees and penalty interest rates levied on the banks. And today they pay basically their own supervision and so on, and complain about how expensive these bankers in Frankfurt are, or these supervisors in Frankfurt are. It was the recession that was so costly for fiscal authorities. And what the Troika programs did is to say, well, tough, tighten your belt, just as any household has to do. The old and very commonsensical kind of response that is exactly the wrong thing, as Keynes, in my view, the founder of macroeconomics, has said many years ago. These circuit breakers then became layers, in my interpretation, of a reinsurance system with the COVID-19 pandemic. De facto, earlier, actually, in my book that you have mentioned earlier, I say in the conclusions, this looks more and more like a reinsurance system, and that was 2017. But in fiscal financial terms, this pandemic was like an aftershock of deeply troubled, already in their buildings, structures, quite fragile public authorities. And that is why I think they rethought the whole approach to it. Also, the political divisions that this, blaming to some extent the victims of financial panic for all what has gone wrong. And it's not saying that, say, Greece has not done anything wrong with its fiscal policies. Yes, it was on a trajectory that sooner or later would have led to trouble. But it could have had then default had there not been the Americans calling into that council where this was decided and say, you cannot let Greece default, because that creates another Lehman moment, and we can't have that. So the country was not allowed to default, which would have made certain things easier for Greece. What then came is this, what I call these layers of covering the excess loss, the catastrophic loss that member states are overwhelmed with if they had to deal with that. The PEP is this Pandemic Emergency Purchasing Program, another asset purchasing program, but where the ECB said, we also will not let ourselves be restricted by the German demand that these assets have always to be bought up exactly in the share of the capital key of the ECB, when some countries don't need their bonds to be bought up. Even the Germans noticed at the time that actually their interest rates on bonds become more and more negative because the prices are so high if you have to buy all that stuff up, and that has inflationary consequences. So they said, we will now buy up what is necessary to buy up, and they were, of course, the usual suspects from the point of view of financial market investors. Then the targeted long-term refinancing operations, not that it's in any way important, but there the ECB said, we pay banks with a negative interest rates for on-lending to banks, to business. In other words, directly doing something about the credit crunch, right? Which they earlier could only kind of do moral suasion. Here they had an instrument that said, we pay you for it if you do that. They use the banking system as their long arm to help with that transmission mechanism of recession. Fiscal policy, sure, is openly a reinsurance system with which you said, just like the strengthened building codes after an earthquake, why don't you, instead of we just backing you up with 100 billion of very quickly paid out, very cheap credit, your unemployment insurance, why don't you do job retention schemes? If you lock down everybody, instead of then businesses doing what a capitalist business does, says, we have no cash flow, we have to lay off workers, right? We can't pay their salary for not producing. Why don't you cover those costs and people stay on for people who were already stressed, right, by this whole situation, but also businesses surviving, keeping their human capital, and that was an extremely good policy. And almost like saying, strengthen the building code, strengthen your employment policy or unemployment policy by doing job retention or short-time work policies, rather than just doing what one does in ordinary recessions. The European, the ESM, the stability mechanism, is still in search of a role now, because it has become, through the Troika program, so toxic that nobody wants to use it anymore. Was so thinking also about doing something in this pandemic, and came up with a fairly big contingent credit line to the worth of 2% for every member state, and it is noticeable that it is for every member state, in order to take out the stigma that you have to go to the SM. So Germany also, and the Netherlands, and all those countries that didn't need, in times of such cheap credit, that they could raise, or bonds that they could issue. They also got this access to a contingent credit line that had the worth of 2% of GDP. Not a single country has asked for it. And that had partly to do with the next. And that is this huge fund that came about. It was in the making, and it had been planned and had been discussed between France and Germany when Macron had earlier talked about a budgetary union for more of a fiscal union for the EU, and was then put aside. But what it was is 750 billion grants and cheap loans for recovery, and you get that against plans that you have in detail to negotiate with an expert part of the Commission detailed commitments to reform and investment. I mean, the detail is really mind-boggling. These milestones and targets that you have to mention again. That's the building code idea. Rebuild. Do not just stimulate these economies when they try to recover. Rebuild them and transform them through this reinsurance that you give them. Okay. So just to show you briefly the reinsurance as a system. You have a systemic banking crisis, that is with which everything began. The central bank went in with instruments that we didn't know of before all this happened. And they didn't do the old rule that you may all have heard, the Waltraud rule. It's always wheeled out whenever we have a banking crisis, lending of last resort, and you should follow the Waltraud rule. If you follow the Waltraud rule in almost any systemic banking crisis, you aggravate it. Because what you're saying is, oh, I'll charge those of you who already can see that they have a liquidity problem with a penalty rate. And what they do in a systemic banking crisis, you sell assets in order to generate liquidity that you can't raise anymore in markets. So this fire sale that then drives up in, the yields and down the prices. So the good collateral that you also should always call just disappears before your eyes, right? And it's the market that does this. It's not that they don't have it. What was once a good collateral in a systemic banking crisis becomes bad collateral. That's why you try to get rid of it before it's worth nothing. So this, just for your future, whenever somebody says, yeah, and you should watch, and there was criticism from some economists that the ECB did not, nor the Fed, nor the Bank of England, did not watch the Waltraud rule, just raise your hand and say, how exactly would that work in a systemic banking crisis? It is one of these myths that are just reproduced, and that's why I'm telling you, it wouldn't work. And they were much more creative and did more or less the right thing, because this was really a difficult one. It was not that households ran on banks. It was banks running from other banks in wholesale markets. We had bank runs. We had never seen anything like that before. It's probably the one crisis that Minsky or Kindleberger have not talked about because it wasn't there. So you had to be a bit creative on this. That led, as I said earlier, to solvency problem of some member states, because the financial markets pick out the usual suspects. Whether that's why Belgium wasn't in trouble, who knows? And then we had sovereign bailouts that did take care of something which central banks can do for a while, but by just buying up those assets of which we know they will fail, they are from insolvent institutions. That stokes up problems, and they have probably done too much of it, partly because the sovereign bailouts were not enough, and the restructuring programs of member states did not go fast enough, and they didn't go far enough, because they, of course, feared that if they go really resolutely about restructuring their banking systems, they may become target in bond markets. So the whole thing was blocking itself, and the lending of last resort went further than it probably, and market making of last resort went further than it was. The conditionality of these programs attached to bailout programs, namely austerity, was also not exactly helpful to be confident that this would be the solution. If Greece's GDP development looks like it was in a war, because only in Ukraine and such places do you such a negative income dynamic as we saw in the case of Greece. Part of it is the bubble, that they overstimulated their economies, but part of it is also these austerity programs. The reform part was much better, and actually better than is usually given credit for. I mean, the pension system in Greece is today a much better, broader, more inclusive pension system, but the austerity, boy, that was another matter. The solvency problems of some banks, as I said, that member states were a bit reluctant to deal with, came then with the banking union. At least the beginning was made. under the blockage of Germany, Germany blocked almost every element of the banking union. It did not want a banking union and thought the UK will help it out, because the banking union, the whole financial services regulation, was, of course, a single market issue. The notion that I also critique, that I often read about the euro area design or setup, is they didn't think of having a common prudential supervision. Well, they did think of it. It just was not possible. The monetary center and the financial center of the euro area is a country that is not its member. That was London, right? And London was not keen on saying, yeah, you regulate now financial services as you need that for the euro area, and then we'll do something extra. No. And so therefore we had a system that was probably open to abuse. We know that we had actually extremely high standards that were not enforced at the national level. That was one of the problems of Ireland, for example. And now we have, and when the UK then said, Osborne, the Treasury Minister, then, for God's sake, do a banking union if you can't rein in this euro area crisis that affects us so negatively economically. Germany was suddenly, whoops, that we hadn't expected, and then came out and really tried to block at every twist and turn. De facto, before that speech that Draghi gave, we will do whatever it takes, he got the okay from the council, and particularly in a very small grouping of 4 prime ministers in the room of the 4 biggest countries, to say, yes, he gets a banking union, and then he has to go out to give this speech. So that was Super Mario's, actually, I think, declaration of defeat, that he had to say, we do whatever it takes, because that stokes up the problem of risk-taking and moral hazard in the financial system for the next time. But he had to say that this was the reciprocity that was there. The solvency problems of some banks can now be solved. You got also macroprudential instruments so that you can actually deal with these transnational banks without having to rely on national supervisors who always protect them too much. The problem with the single resolution mechanism is that it is too small. And then with the long-term scarring from the recession, of which I told you earlier, there was nothing that cut the circle at that point. The Recovery and Resilience Facility is a very bold step. I'm not quite as optimistic as everybody is that this is the breakthrough, because I think if you force countries within 5 years to spend so much money, it is bound to be abused at some level. There may be idiosyncratic cases when overall the money is well spent, but depending on how this will politically play out, this is a success story or a failure, and it's beyond the control of the EU what will come out. It depends on how, especially in Germany and in Italy and such places, the discussion goes. But for the moment, with SURE and the RRF, you got macroeconomically relevant fiscal means for reform and investment, almost the reinsurance case in anticipation that this is going to be too much. Italy just could not have done anything if it didn't have got that extra money, and they had it all in the drawer. The policies that they were asked to do for childcare facilities and some infrastructure programs, it's not that Italy has anything against this. It just has no way of doing what the European semester constantly tells them to do. Now to the politics. If this is such a wonderful system, how did it come about when this was not by design? And you kind of need to look at it from hindsight and say, look, this is what it is. And with problem after problem, they have a kind of reinsurance system that never is just co-insurance. It just takes off that part that overwhelms the member state. Because governments of very different ideologies, and they can change with member states. I warn you a little bit of always saying Germany does or France does, or, governments change and they have traditional views, but not always. It's often the domestic political situation on which a government on the left and a government on the right has to take care of and be aware of. So the domestic median voter preferences play a role. If you are skeptic of further political integration. Then reinsurance, if you admit at all that there may be a case for risk sharing, and I think doing ever more interdependence through integration and saying none of that is any matter for common concern or common institutions is just not tenable. You want countries to financially integrate, monetarily integrate. Integrated markets are channels for spillovers and so on. You have to say that there must be some risk sharing of these risks that come from interdependence. The moral hazard problem that you take more risks because you know in the downside case you will be bailed out by the others, by the insurance fund, is much less of a problem here. It's not existent, but this is normal for any insurance case. And we don't say we should abolish the welfare state because you had some moral hazard problems. That moral hazard problem is much less relevant because the whole risk before the catastrophic one is on you. The losses are high on those who get reinsurance. So you would not want to risk that situation, or it's absurd to accuse anybody of this. They benefit those who can help themselves in normal times. So yes, the Netherlands has high fiscal capacity. But come climate change, we will see how that plays out, right? It is a low-lying country and may need it. Germany has just got a little bit off its high horse that it would never need any help with the energy situation. Suddenly that came with the Russian aggression against Ukraine. Then there are others who are actually, and I think Germany is one of them, they have quite volatile and inconsistent preferences. Sometimes they do big leaps. Merkel declaring with Macron this RF. And then at other times block anything that would help with a bit of a solution in the beginning of the euro area crisis. For them, you can get them around by showing that for specific contingencies, say that we work together for the recovery from a pandemic, can work and is a good experience and has political advantages. It can also be devised as a temporary thing because in contrast to a co-insurance system where the whole system must correspond to each other and you need a certain institutional homogeneity, that's not what you need with a reinsurance system. It can be monetary policy, it can be a fund, it can be a particular reinsurance scheme like SURE that you have created. It can be different mechanisms. It is not always fiscal. And temporary reinsurance system can then allow these countries whose preferences depend on the experience they make to wait and see. And I think that is the wisdom of a temporary RRF. We don't know whether it works on that scale, right? Those who always criticize for this temporary, how can you do such big things without ever testing them before? If we could have tested the euro, it would have perhaps been a good idea, but that's something you can't just test, a common currency. If we now can test with fiscal and do something sometimes temporarily, I think it's a good idea. Then there are some who would like to go the full way, right? France at least says so. Sometimes it also doesn't quite put its money where its mouth is, but it is consistent in saying we should go further. For them, it at least is a way into such a permanent system. The coverage of highly uncertain risks can be one for where you take also more predictable risks. It can demonstrate to the others the value of membership, bringing around Germany and such more volatile members, and then perhaps the skeptics can be overridden, although this will be, of course, a decision that's not made just by qualified majority voting to go into a fiscal federal co-insurance scheme. So why did the EU converge on a system of reinsurance? I put it here very generally, but you can see why for some politicians this is more important as an argument than for others, and that there is contestation. The legal hurdles. Anything that requires treaty change is a no for France these days. It's why we do everything a bit sideways and not quite as lawyers would like to have it, but that's what is there. You cannot introduce a federal budget into the EU treaty without changing that treaty. So that is one blockage. The next, and I think the most important, those who always say, well, we need to complete the EU. How exactly? When there is not, after 15 years of crisis, a great enthusiasm about voters just waiting for you to do this decision. We know that there is a constraining dissensus, as we call this in European studies, in many member states, that requires taxing powers to the EU level, legitimation for all levels of government, in other words, an elected EU level. That's at least how our democracies work right now. While targeted reinsurance can be financed by pooling guarantees, nothing is ever paid. There's no tax money involved when we build these huge funds. And you know, the European Stability Mechanism is 3 times bigger than the whole IMF at its highest lending capacity. Nothing has been paid by Germany or anybody. It is a guarantee of governments that should somebody default, and when Greece defaulted the second time, it was not paid by the public credit guarantors. It was paid by the private sector. So underpin the issue of low-cost debt, and so they raise debt with these guarantees, and they are paid back, and nobody ever asks a question again. Finally, not to be underestimated. Does any of us know what is the ideal fiscal system? No, we don't. And therefore, there's even something to be said to let some experimentation, some diversity coexist. Hard to do if you're a co-insurance system, because otherwise you can have this issue that some free ride and have a very badly designed system and always hope that the co-insurance from the federal level will compensate for it. It's one of the problems of southern states in the United States. You don't need harmonization of national fiscal systems, and you don't need a dual budget, because that's the other problem. If you today go fully for fiscal federation in the euro area, what happens to these non-euro area members, right? Among them, the Scandinavian countries, some Eastern European countries. It would create a crisis of the EU and perhaps the euro area going it alone. So my conclusion is, I think the EU polity has a fiscal system that nobody acknowledges. It is a reinsurance system that we haven't seen historically before. And it may be for the economic and or monetary union. So whether you think in EU terms or in EA terms, at the moment they have gone for the EU as a whole, because even the ECB's help has helped a lot with mortgage markets in Eastern Europe that had a lot of euro area debt, and it could do swap lines with other central banks. That system may be best suited, given that we do not know how to move legally and politically to this complete never land of a fiscal federation for the euro area. And at the same time, we need some fiscal capacity, because increasing interdependence does need some way of containing crisis that may that spill over from one place to another. That much is true, but it can be done through a reinsurance system, and my argument is that is possibly preferable. Thank you.
Very stimulating start of the conference. We have about 15 minutes for questions and discussion. Not everyone at the same time. Use the microphone, please.
I have a question. I have a question about the pricing mechanism of this
pricing mechanism.
Yes. So if I understand correctly, the insurance mechanism, the riskier you are, the higher the price that you pay for the insurance. What about the reinsurance in the framework of the EU?
Since nobody else is in the list. Well, obviously, this is when you move from private reinsurance to public reinsurance. There is no premium charged, right? Why? Because imagine what that would mean. Would you now say for the ESM use, you charge countries, you charge them in terms of these adjustment requirements that you make? Because you say something in your policies and how you dealt with the obligations of membership in the EU or in the euro area was not quite as we would have liked. Otherwise, we would not be in such dire straits. And boy, Greece did pay probably more than anybody would have ever asked them to charge in terms of a premium. That is the way of how you deal with uncertainty. There is a cost in terms of that you hardly ever give unconditional. In fact, the European stability mechanisms contingent credit line is an unconditional credit line, but it is still earmarked for healthcare related spending. But in all other cases, as I told you, they have to do difficult reforms that they could not do beforehand. And in a way, you can say that's the pricing. Now, that will never satisfy an economist, because whether that's exactly in relation to the risk. But let me say this, a reinsurance system is often, you have uncertainty and you have historical data. It's one of the things that the reinsurance industry right now grapples with, because reinsurance has become, the reinsurance payouts have become much higher over the last 10, 20 years, and has to do with climate change. They will change. And the problem is that almost already there is a kind of retraction from the reinsurance market by some, because they say we can't even calculate the premiums anymore. And if we charge them as we see them, we can't sell the policy, because everybody then hopes that it will just not happen to them. We see and this is why I'm interested in this. Before I talked to Stephanie briefly about it, this is actually something we have to rethink. There may be a market failure of systemic proportions, namely that the whole private reinsurance system doesn't work anymore. It has already become much more expensive. And my reading of this report from Christchurch was that certain contracts, like the second payout, we shouldn't do anymore. This is way too risky, because every shock has an aftershock, and how catastrophic that then is, how much buildings were already, damaged in their structure, and therefore the next round will be even more costly, means there is no reinsurance then. At a time when catastrophic risks actually accumulate and become more. And this is then what a public system can do. It's like social insurance in the welfare state. The social assistance system in particular doesn't define anymore why you are exactly without any income and fully destitute without this assistance. It absorbs this uncertainty by not stipulating for which case this is. We are not there in the EU. If you would do that today and say, we give a blanket reinsurance for all contingency that overwhelm the member states, I think the others would say, no, we can't do that. That's why it's so specific. And then you can each time tie to that, this payment ex post, namely adjustment of something you find politically very difficult to do otherwise.
Okay.
Thanks, Waltraud. That's very. I find that very intriguing. The whole, like the way you think about solidarity, I guess, in the Eurozone in this way. So I thought a little bit about how the conventional reinsurance differs from what you sketch out here. And there's two things, and this relates to the questions we just heard. One is the premiums, of course, right? They're not paid in advance, not clear. The other one is also the flexibility, because it seems to me that, in conventional reinsurance, you sort of know what you're getting yourself into. You also know sort of what the terms are, what you will be getting out of it. And what you highlight in your talk is the flexibility in the way they addressed it, and sort of the ad hoc nature also of these measures. So it's not clear in advance, what the reinsurance will look like. So I wondered, what are the implications of these differences between the, say, EU style reinsurance and conventional reinsurance systems? And what are the differences this implies for the effects of what it has, right? I mean, it's much less plannable. And I guess that's sort of, it seems to me from your discussion, it's a feature, not a bug of the EU system. But of course, the conventional reinsurance doesn't work that way. So I would expect there would also be differences, right? So what are your thoughts on that?
Immediately? The answer, I can do any, what you prefer.
Well, we have like 4 or 5 more, maybe first collect a couple and see how we're doing with time. You are next.
Well, thanks.
Hello.
Waltraud, for your talk. I mean, you briefly touched upon this in your answer to the previous question. But when you started out with the earthquake example in New Zealand, I wondered, I mean, how far this concept might travel in the EU beyond the financial policies, because the conditions you presented for why this system works and why it is preferable to a federal co-insurance, those seem to apply to many policies across the EU portfolio. And so I wonder what your thoughts are on this. And say part B of the question is, I mean, we've seen, for instance, in health policy, in defense policy, say new schemes of joint provision. And I wonder whether you think these also fall under, let's say, this idea of reinsurance.
Thank you for the great keynote. One point that I found fascinating is when you mentioned that for a fiscal federation, this would require reopening the treaty, and some are clearly against. I mean, if there is one thing we don't want to do, that's reopening the treaty. Now, working at the Commission, this is an attitude that I kind of see quite often, of course, at lower level of legislation. But when we discuss, for example, level 2, very often I hear, well, no way. There is really no appetite for reopening level 1 with no reference to any particular regulation. But also when it's clear that level 1 has limits or the situation has changed and it would require a change in level 1. So there is really no appetite. Now, the question is, why? I mean, of course, we know that reaching a political agreement at any level is painful and it takes time, but it cannot be just that, right? I don't know. What do you think?
Remo, would you like to answer in between? And
let me take the three, because I can be short. Stephanie, the idea that the EU has to be, so that there is too much flexibility, almost that one cannot know what you get out of it, and so to speak, also no predictability. Then, while this is all clearly defined in reinsurance contracts, that's always a bit of a myth, because as the lawyers will tell you, there are huge claims processes. It's one of the problems that you need to kind of quickly assess claims, and then there is a recourse by households a lot, or by insurers, in fact, that say the reinsurer should cover much more than just that. So a whole cottage industry of lawyers is then at such cases, and they drive up costs as well. In the EU, again, it will be, like in any fiscal system, it will be a political process, how this is then played out. And therefore, my answer is the same as to the previous questioner. This is a political process. But that is also, in a way, almost an advantage of the co-insurance system. When you look at places where you have secessionist movements, I think it's like, you know, the Catalonia and places like that, because they think we are trapped in the system in which we pay more, or in which we have not the same right to say if it's a very centralized, devolved system. A reinsurance system is more flexible. Yes, if there's a majority of relatively conservative countries with respect to European integration, that say we don't want ever more political integration, ever more interdependence, where every problem of one member state becomes our problem too, which is, after all, a legitimate concern that you can have in a union that is so diverse. Then less reinsurance will be provided. But to me, this is almost a flexibility that keeps the system coherent. And I would say what is discussed at the moment with defense, NATO is to me a co-insurance system. As soon as a country is attacked, NATO will come in. It's not only, oh, we let you fight until we see that this is not winnable for you, then we come in. So in that sense, it is a commitment for co-insurance. For defense, that makes a lot of sense to me, because you want actually to deter an escalation of conflicts. But for fiscal relationships, I'm not so sure. On your question with the treaty, it's interesting to me that you say this is a kind of almost Pavlovian dog kind of a response in the Commission. Let's not touch this. I hear it from that the French often say, if that is required, then no. They still themselves make often claims or demands on what we should all build that clearly need treaty change then. So there is a bit of an inconsistency in this, I assume, to push and push and push. But I really think this is what I call the domestic median preference. That's where the constraining census is perhaps best to see. Nobody wants even to give a platform for the Le Pens and so on of this world. When you have a debate like that, whether they would always lose, I'm not so sure. But mobilization effect that it would have, especially for Eurosceptic populists, is probably something that the governments fear like nobody's business. I'm not an expert enough. There would be people here who know that better, whether that is a wise way of dealing with populism. I think you should hit them over the head with your arguments instead of always saying, let's not give them no platforming is, in my view, never a good policy.
We have time for one more round.
Can you tell me your name? Then I can write that down.
Can you hear me?
Yes.
Pietro Cova, Bank of Italy, but I speak in personal capacity, of course. And now my question is, you said, of course, we don't know what the ideal fiscal solution would be, no?
Yeah.
But we know that a single a single monetary union with many fiscal authorities is not the ideal solution. We see it in all crises that, when the fire comes, for example, in the US, there is always the treasury bills or the treasury notes, which are the ultimate, let's say, safeguards, if you want. And we don't have it in the monetary union exactly because when the crisis struck, everybody is issuing their debt in some money, the euro, which, except for Germany, for example, which is also in control of the fiscal situation in difficult times. So what would be the counterfactual would be a monetary union with a fiscal union. What would be the cost of the insurance there? Have you thought about it? And I know that politically this is not feasible, but as an economist, the ideal would be to, let's say, have in mind a situation where you get the best from fiscal and monetary together. Thank you.
There's one here. No? That's also you. Yes, exactly.
So, hi, my name is Anna Nasrodi. I'm also from a central bank, but I speak for myself. So my question or views do not represent the official views of the Central Bank of Hungary. And my question is related to a kind of shift in the policy making over the last 20 years. So I don't know whether you agree with this statement or not, but according to me, 20 years ago, when the new member state joined the EU, the debate was much more, and the target of the policy was much more about convergence, and so the catching up of the countries, so then we mostly talked about the first moment of the distribution, and now we mostly talk about the second moment, the risks. And I don't know what you think about that. So isn't there a time inconsistency there? Isn't there? Yeah, I think you understand my question.
Yeah, thank you.
Go ahead.
Hi. Joris Rosse, KU Leuven. I don't think I have to disclose a disclaimer. But so my question is actually related to his question about that you've sort of presented this as a substitute for the fiscal federalism approach to it. But one, I think, advantage that has is that it sort of inherently tries to get these structural reforms and sort of homogenize the union, in which potentially country-specific risk would be lower and potentially monetary policy for the whole union would be more powerful. And given that it doesn't really seem to be present in the reinsurance framework, I was just wondering whether you sort of see the reinsurance framework as a short-term solution given the current status in the union, or whether you also see it as a long-term substitute for a fiscal union.
Simon, last question.
Simon Hook, I actually am also following up on some of the previous questions as a scope question. You developed your argument basically in the European Union, but one wonders a little bit whether that is a proposal that would actually also be attractive for other monetary unions, or under what circumstances, and whether it's linked actually with the second point that you have here on the slide, whether there are conditions under which this might be a feasible way to deal with some of these issues.
I mean, the last question is a nice one to wrap up the others in a say, if it's such a great idea, why do other monetary unions not have a reinsurance system? That comes to a question that I have only as a question at that point, so I didn't want to raise it, but I was sure I would come to it. In a reinsurance system, what we don't know yet, if you fully declare it, right? I'm saying this has evolved in a type of social evolution process that you can see why such very different parties with respect to that could agree on it, but it's not something even politicians are aware of. Because as famous as Waltraud Schelkle may be, she doesn't, she's not daily read by like Adam Tooze or somebody like that. It is because in a way you say the EU comes in only when we do very badly. Now you could say when we do really badly, the EU comes to our rescue. That would be the positive political reaction. Once you are in a denser polity, with, for example, a parliament that represents the citizens of the whole, not a parliament along national lists and things like that, and whereas we still has very limited powers, then I think the negative reaction, they only come to our rescue when we're really down and out. And this would be my shortest answer, but de facto we don't know. We don't know because we haven't had, I have never read in the federalism literature, although I would like to know whether a coming together federalism type has actually had its origins in reinsurance ideas. But once you have a kind of nation state that evolves and is then a federation, I think this negative reaction that it is too minimalist would be an obstacle to it. That is my hunch. And that then takes your question, your name I didn't understand, and the one by Pietro. Clearly, the present one is not ideal to have such fiscal systems, especially in your area, with one central bank. On that we can agree. At the same time, you can also not overnight say, and now we do the following system, right? This was my point. And actually, my argument was, and then it takes years on a bit, this convergence idea was to me always wrong. And one of the problems from my point of view with structural reforms is actually that we become too similar and have the same problems as markets sometimes have. We all run for one idea until we notice it was not a good idea. It had disadvantages that we didn't see before we did it. So a bit of diversity, it's the risk sharing idea. Too much homogeneity of your risk pool is a bad idea. And we are in that situation. We are a polity that is not out of, I don't know which ideas that nation state made them so, is even the idea of a unitary nation state. But for the EU, clearly, it wouldn't be feasible. In that sense, it would become a problem that we have such different income levels, such different institutional traditions, and so on. So diversity is, in my view, only compatible with that kind of fiscal system. And in that sense, it's an alternative. I'm not thinking of first best Walrasian general equilibrium model of a fiscal federation and all that stuff. It's the practicalities of a union that you find is very diverse, and where these member states are all terribly proud of themselves and would think their model is the best one. Perhaps the Italians are the only ones who wouldn't say that. So to me, it's also not that there is a dynamic inconsistency in the EU. I mean, to me, this was all born out of this optimal currency area idea, which I try to trash whenever I come across it, because it was always ridiculous to say you do a common currency in order to in order to deal with asymmetric shocks. I mean, with asymmetric shocks, just like that, like business cycle shocks, market should be easily. All you need is then financial integration. Now, financial markets don't work like they should. According to optimum currency area theory, namely such that you can actually ignore them. Optimum currency area theory has no financial markets in it. The one strand that had exactly that idea, that it said we should just make sure that we become financially very integrated, and then naturally, if we hold claims on each other, if our economy is down, my employment is shaky, I have still a nice income from that other region that does well. Again, would support diversity that you need for this to work, and unfortunately also fairly efficient financial markets, and equal access to holding wealth and claims on each other, which is the other problem of that idea. But at least that was one strand of literature that faced what if we take into our optimum currency area literature financial markets, is then this homogenization all need flexible labor markets, mobile labor force, same product markets? No, we don't. We need diversity and share that across regions. That I grant that literature.
Thank you very much.
That's it. Thank you. Thank you very much.